All right, let's talk about something that feels, well, completely backward in trading. We're going to talk about the incredible power of doing absolutely nothing. Yeah, I know, sounds a little crazy, right? But what if the single most profitable move you make all week is the one where you just sit back and watch? Let's get into it.
I mean, this is the big one, isn't it? It's the question that keeps people up at night. We spend all this time learning super complex strategies, we plaster our charts with indicators, all focused on when to get in and when to get out. But what if the real reason so many traders fail has nothing to do with the trades they take, but everything to do with the ones they don't walk away from?
And that right there, that's the whole secret. Winning in this game isn't about hitting home run after home run. Nope, it's about not striking out on the easy pitches. Think about it. Every terrible trade you sidestep, every trap you don't fall into, that's capital you've just saved. That's money that stays in your account, ready for those truly amazing A-plus setups.
So why do we do it? What is it that pushes us to jump into these low-quality trades when our gut is telling us to stay away? Well, it usually comes down to this really common psychological pitfall, something I like to call the overtrading trap. Let's dig into the main cause of this.
Ah yes, good old FOMO, the fear of missing out. It's that little voice inside your head that just screams at you, hey, that rocket is leaving the station and you're not on it. It's that feeling that makes you throw your entire trading plan out the window and just chase a price because you're scared. FOMO is the enemy of discipline, and it is the #1 reason traders make very, very costly mistakes.
And this slide really shows the huge mental shift you have to make. See, the amateur thinks that being busy equals being profitable. They're on this hamster wheel, just clicking buttons, thinking more trades means more money. But the professional, they're like a sniper. They can wait for hours, days even, just for that one perfect shot. They know deep down that one high-quality trade is worth 100 impulsive ones. It's about quality, not quantity.
You should probably print this out and tape it to your monitor. Seriously, because before you can even dream about making a profit, you have to be obsessed with not losing the money you already have. Your capital? That's your lifeblood in this business. So before you click that buy or sell button, you have to ask yourself, is this trade protecting my capital above all else?
Okay, so we've got the psychology sorted. Now let's get our hands dirty and look at some charts. How do we actually spot these capital-draining, high-risk environments in the wild? Let's walk through some of the most common situations where the smartest thing you can do is absolutely nothing.
First on our list is the dreaded choppy market. You know what I'm talking about. This is where trend-following strategies just get completely wrecked. The market isn't trending up, it's not trending down, it's just bouncing around in a range with no purpose. Trying to force a trade here is like trying to surf in a kiddie pool. You're just going to get knocked around and go absolutely nowhere. So, how you spot this mess? Well, there are some dead giveaways. The candlesticks will look all jumbled up and overlapping, like they're in a mosh pit instead of marching in a nice orderly line. You'll see the price just getting stuck, failing to make any new highs or new lows. And your indicators, they'll be all over the place, giving you buy and sell signals at the same time. And if you look at the volume, it's going to be weak and totally unconvincing. When you see this on your chart, that's your cue to go make a coffee and just stay away.
Okay, next up, the volatility trap. This usually happens right around a big news release, like an inflation report or an interest rate decision. The market just explodes in one direction, sucking in all the breakout traders. And then, bam, it violently reverses, stopping everyone out, and then sucking in sellers on the way back down. It is pure, unadulterated chaos.
And the signs are pretty hard to miss. You'll see these candles with crazy long wicks on either side. It's a sign of a huge battle between buyers and sellers where nobody won. You'll see a massive, out-of-nowhere spike in volume that just disappears a few minutes later, and it almost always happens right in the minutes after a big news announcement. The pros, they know to let this storm pass before even thinking about getting involved.
Now, our third no-go zone is a little more subtle. It's called market exhaustion. This happens when you have this beautiful, strong trend that's been going on for a while, but it just starts to look tired. It's like a sprinter at the end of a race, losing steam with every step. This is a super dangerous time to enter because you are very likely buying the exact top or selling the exact bottom, right before the market either reverses or just goes flat for a while. And the clues here are all about momentum just fading away. As the price grinds to a new high, take a look at the volume bar. Is it getting lower and lower? That's a huge warning sign. Are the candles themselves getting smaller, like they're running out of energy? And then there's the classic signal, divergence. That's when the price makes a new high,
but your RSI or MACD indicator makes a lower high. That is the market literally screaming at you that it's out of gas. You gotta listen to it. So we know what the bad neighborhoods look like on the chart. Now, how do we make sure we don't accidentally wander into them? It's time to build a fortress around our trading capital. Let's create a practical defensive playbook to make sure we avoid these traps consistently. This 4-step process is basically your shield. First, and this is non-negotiable, you must have a written trading plan that clearly defines your A-plus setups. If the market doesn't show you exactly that, you don't trade, period. Step 2, know when you're trading. Steer clear of those low-volume dead zone hours where price can do crazy, unpredictable things. Third, be patient. Don't try to guess where the market is going. Wait for it to show you. And finally, if nothing meets your criteria, just become an observer. Your job is to watch and learn, not to force a trade that isn't there.
Now, to actually follow all of these rules, you need one critical skill that holds it all together. And I want to be clear, this is not a passive thing where you just sit around. No, this is an active, powerful weapon in your arsenal. It is the mastery of patience.
And look, here's the real-world result of all this. Just look at this table. The overtrader, driven by FOMO, jumps into a choppy Bitcoin market, gets whipsawed around, and ends the week down 15% on their capital. Ouch. Now look at the patient trader. They see the exact same choppy market, they recognize it as a danger zone, and they do nothing. Their result for the week? 0% loss. Their capital is 100% intact, ready for when a real opportunity shows up. They didn't make money, but more importantly, they didn't lose money. And in trading, trust me, that is a massive win. This one really hits home, and it's the absolute truth of this business. There will always be another trade, another setup, another opportunity. The market isn't going anywhere. But your capital? That's a different story. That can disappear. Protecting it has to be your #1 job. Always. So here's the ultimate payoff, the main point of all this. Sitting on your hands is not lazy. It's not passive. It is an active, strategic, offensive decision. You are consciously choosing to preserve your ammo, your capital, so that when that perfect textbook A-plus setup finally comes along, you are financially and mentally ready to take full advantage of it. And that brings us to the end. So I want to leave you with the question to think about for your own trading. What is your personal red flag? What market condition is the biggest signal for you to just hit the brakes and step away? Is it that messy, sideways chop? Or is it the crazy volatility around news? Knowing your own do not touch zones is a huge step toward becoming a more consistent trader. I'd love to hear about it, so drop a comment below. Thanks for watching.